Let's talk more about the broader moves in the market and what we're seeing overseas as well as here in the United States. Peter Boockvar, the CIO of Bleakley Financial Group, also a CNBC contributor, out this morning. And Peter, you're pretty concerned about what you're calling violent moves this morning. What do you think are sparking those violent moves? Where do we go from here?
Well, on the FX side, it's certainly the aggressive Fed that was reinforced on Wednesday. And the follow-up with a lot of rate hikes yesterday by a variety of central banks that's leading to this sharp rise in interest rates. I mean, we've had so many years of artificially suppressed interest rates. I mean, just visualize all of them just sitting on a beach ball in the water, and once they get off, that beach ball is going to spike higher. And I think that's what we're seeing right now.
Yeah, that's a pretty specific picture of what happens when that comes skyrocketing out. Is this a situation where we're seeing all of that right now and you think it plays out in the next week or so, or where does it go, I guess, Peter?
I think in the very short term that these moves are so acute that it's probably a capitulation. Again, I emphasize short term, and that maybe we've seen a short-term peak in this dollar move, a short-term rise in yields. But over the next couple of quarters, this certainly can continue as just a general unwind, again, of a decade plus of artificially suppressed interest rates, where at the peak, we had $18 billion worth of bonds yielding below zero, and now that's actually slightly in positive territory. But even with these rate moves, interest rates are still well below the rate of inflation, not just in the U.S., but elsewhere.
The two-year yield, I mean, if you think about where the two-year yield was about a year ago, Peter, I mean, we were at less than 0.25%. So the move over the year is just bananas, to use a layman's term. We were talking to Richard Fisher, the former Dallas Fed president, earlier, and he was saying, you know, the credit markets are functioning and things look very, very orderly. And I would agree with that. But when you see this volatility in the fixed income market, when you see the volatility in the currency market, do you think to yourself, this is not right? And I understand that things look okay on the surface, but there's something else that's going to rear its ugly head. I mean, it just doesn't seem normal to have moves that we're seeing in the currency markets in developed countries that are moves akin to what goes on in emerging markets.
You're absolutely right. And I do worry about the liquidity and what this means for the trading and other things. I mean, if there's liquidity challenges in the treasury market, which should be the most liquid in the world, you can only imagine what the liquidity is going to be like in the leveraged loan market, where it takes a couple of weeks just to clear a bond. So I think that the Volcker rule, which limited banks' abilities to make markets because of higher capital needs, that there's a lot more friction to trading. And we're going to have to start to get used to, and to what you just said, more third world type moves in developed markets.
Peter, does that get us back to the point? I mean, the things you're talking about now, the friction that comes with trading, the difficulties companies will have trying to raise funds in the bond market. Does that get to this point of other people we've heard, Barry Sternlicht and many others in the last week or two, who have been calling for the Fed to maybe slow down and pause and take a look around at this point? Or is this something that they just have to live with because inflation is so inherent in our economy and here and around the globe at this point?
I think because of the delayed impact of a lot of these rate increases, I do think they should be slowing the pace of these increases. I can agree with them that they want to get to 4.5, but it's the speed at which they're getting there that is creating the most amount of danger right now and the most amount of disruption. I mean, they can say, okay, inflation's high, we need to quickly raise interest rates, but the rest of us have to live with the velocity of their rate increases. And you can only imagine the housing market slowing with the mortgage rate at 6. Now mortgage rates are closer to 7. And what that's going to do to at least that market. Or if you're a leveraged loan borrower going into this year, you did not budget for a 400 basis point increase in interest costs.